In today's video, we're going to take you through how to get a home loan approved today, including the way the banks actually look at your loan application, the things they look for, and even how far back they look through your records. So if you're looking to apply for a mortgage this year, you're going to want to watch this video. All right, Nathan, starting from the top, the first tip is debt to income ratio. So this is something that's brand new, has only just come in the last few months. What are the banks looking for here when they're testing your DTI or debt to income?
Yeah, this has been one that's really been used to try and alleviate the crazy market and slow things down a little bit. It's effectively where the banks are looking at your income as a multiplier of your debt. So they call it debt to income ratio. So for example, if you're on 100 grand, the debt to income ratio that a lot of banks are using nowadays is they say we'll only lend up to 6 times your income. So at 100 grand, that means your maximum loan amount is 600,000. Now, in many cases, your borrowing power far exceeds this debt to income ratio. So for example, prior to these changes, your borrowing power was actually $700,000. So you can actually borrow a lot more, but the debt to income ratio has reduced your ability to borrow. So be aware of this. There are a number of lenders that are actually limiting debt to income ratio to no more than 6 times. There's still plenty of lenders that will look between 6 and 7 times, and some that don't even look at debt to income ratio. One to keep in mind, particularly if you're applying for a bank and you're needing to borrow higher than 6 times your debt to income ratio.
Yeah, the other thing I've seen a lot in this space is it actually depends on your deposit too. So if you have your minimum deposit, so if you have less than a 10% deposit, in a lot of cases, the banks, especially the bigger and even the smaller banks, have rules where if you've got more than 6 times debt to income, it's a flat out no. No consideration, no ifs, buts, and maybes. If you've got a bigger deposit, they'll even be willing to go up to 9 times debt to income in some cases. So it's definitely worth chatting to your broker. You want to check that out first because you don't want to get your loan declined on this little rule that's just come in recently that could catch you out. And like Nathan said, there's some banks that actually don't even consider debt to income at all. They don't care. It's not in there. So if this is an important consideration for you, definitely chat to a broker, can help out. The second thing, the big mistake, I guess, and the thing that can help get your home loan approved this year is the property. Surprisingly, the type of property, the location of the property, even, where you're buying, what you're buying, if it's a townhouse apartment, makes a massive difference. Nathan, talk us through, why does the bank care about the type of property you're looking at buying?
And this is a big one that a lot of people that get pre-approved get caught on. Effectively, not all banks are the same in that some lenders have postcode restrictions where they'll flat out refuse to lend over a certain amount in particular areas, mainly inner city apartments. There are also some areas that they're blacklisted. Another peculiarity with some of the other lenders are they actually have restrictions on the buildings that you're looking at. So if they've got more than a 25% lend in that particular building, they'll say no more lending, which once again means you could actually get declined even if you've been pre-approved. So one to watch out for. Postcodes are a big thing. We've seen this a lot with the first home loan deposit scheme, where we've had clients that have been approved for the first home loan deposit scheme. Then they've found a property in, for example, an inner city suburb like Brisbane CBD or Sydney CBD. And then the banks actually said, no, we won't lend 95% with your LMI lender's mortgage insurance.
I had this on one just last week. So we had some customers that bought that was a house. So usually this scheme, the postcode restrictions was just on strata title property. So as if it was a unit or a townhouse, like Nathan said, in CBD locations. But with my clients, they found a home in Redbank Plains, which is kind of southwest of Brisbane. And it was a house. It wasn't strata, it wasn't anything else like that. And I was on the first home loan deposit scheme. So technically speaking, with the first home loan deposit scheme, you should be able to put in with as little as a 5% deposit. But this bank had a postcode restriction in Redbank Plains. It was against everything. It didn't matter if it was a house, townhouse, unit, any property in that area had to have a minimum of 10% deposit. So even though the first home loan deposit scheme meant they could put in potentially 5% deposit, this bank said, no, we're not going to accept that property. You need at least a 10% deposit regardless in that area. So definitely, like Nathan said, even if you got a pre-approval, you think that the bank said, yep, we're happy to lend you, Nathan, $500,000 to buy your first home. They could say no if you choose the wrong property. So you definitely want to run through that with your broker before you're even making an offer, because it could derail your plans when you're buying a home and mean your loan's going to get declined even after you've been pre-approved. The next one, Nathan, the third tip we've got is kind of get your deposit together. Why is this important? Like, does it matter that if you've got gifted funds, it's kind of all over the shop? you've got in different bank accounts. Why does having your deposit in one place, and I guess showing a bit of a history there, an important consideration to make sure your loan's going to get improved this year?
I think the big one here is with your deposit, and particularly if you're putting down a minimal deposit, the bank's going to look at something called genuine savings. Now, genuine savings actually is different from lender to lender. So some lenders will need to see genuine savings if you've got less than a 15% deposit. Some other lenders actually only need a genuine savings if you've got 10% deposit. Effectively, all that means is you need to demonstrate to the bank that you've saved up 5% of the purchase price over 3 months or longer. So this is important if you're wanting to purchase a property in the near future and you've been gifted funds. It might actually make sense to get the funds in your account earlier so you can show it held in your bank account for 3 months or longer. Another interesting thing here is that banks can accept rental history through a licensed real estate agent. So if you've got 12 months of good repayments on your lease, that can actually be helped. That can be used to help get your genuine savings being met.
Yeah, I guess the caveat there with that rental history is they don't use the amount you paid in rent as deposit. You still need to have, say, your 5, 8, 10% deposits. You have to have your 20, 30, 40, $50,000 in your account. It could be gifted from mum and dad, but you don't need to have saved up progressively over that time. They could just kind of gift you that money. It can be used, and that can be fine with your deposit. It's just another way. So I guess strengthen your application to show the bank, hey, I've been paying $400 a week for the last 12 months on my rent. I'm a really stable person. Everything's going really well. And now I want a mortgage. I have enough to save up. And that's a way of kind of getting out that genuine savings rule. So yeah, definitely the big takeaway there, try and tidy up your accounts. If you've got deposits in different places, put them in one spot. And if you are saving, try and keep it so you've got a nice savings history there.
Tip number 4 to making sure you get your loan approved is check your spending habits. Now, this is a big one, especially if you've got health insurances, if you've got school fees, if you've got what the banks call discretionary expenses that are outside their Henderson index, that can absolutely reduce your borrowing power. So Jaden, what's a good tip here for our first homeowners or homeowners out there that are worried they've got Bupa, they've got private school fees? What can they do to try and help increase their borrowing power by not having their spendings hindering them?
Yeah, I think a couple of years ago, we'd say like Netflix and fast food and that sort of stuff would affect your borrowing capacity. And for some banks, it does. Other banks, if it's discretionary expenses like that, where it's a bit of going out and eating, a bit too much shopping, you can make an argument to a lot of banks and say, hey, over Christmas, I spent a lot of money on presents. I went out a lot. That's not going to be ongoing, and that can stop. And the banks will accept that for your living expenses. But like Nathan said, with private health insurance, with school fees, with gambling, there are a couple of things that the banks just say, like, no, we won't negotiate on this. Like, you have to include this ongoing, and it could reduce your borrowing capacity. So we had a client recently who they were sort of gambling a little bit. So there's a lot of money going in, there's a lot of money going out. And the bank actually reconciled the ins and outs and said, well, every month actually you're going backwards $500. So we're going to take that into consideration, your living expenses. And it actually impacted their borrowing capacity by a few $100,000. So you need to be careful with your living expenses and stuff like that. They're going to take that into consideration, but definitely on the Uber Eats, on some of those discretionary ones, there's a bit of leeway there, I guess, more now than previously.
I guess moving on to our 5th point, which you just mentioned before, is check your credit score. Now, this is a big one because a lot of times, especially if you're moving, rental properties, you can forget a telco bill, an energy bill. And what happens is if the telco or energy companies can't get a hold of you, they actually leave a default on your credit file. So definitely check your credit file. It is very common that we see our clients having a small telco bill that's been unpaid and has actually left a black mark on their name. So something to be very careful of. You do want to aim to have your credit score over 650 because once again, the banks do automatic assessments in their background. And when you do an application, it'll automatically spit out a yes or a no, especially if your credit score is low, you can potentially get automatically declined.
Yeah, the other thing that the banks have started, well, the credit providers do now, is actually give 2 years account payment history, like you can see here, on any credit cards, personal loans, car loans that you have. And that's live now across Australia, so with all credit providers. So you need to be careful because it can be the case where if you're more than 15 days overdue, it'll leave a mark for the next 2 years on your credit file saying that, hey, Jaden was overdue on his credit card back then, and this is a red flag. And for some banks, especially with some of the probably more conservative banks, like for example ING, if you've got more than one missed repayment over the last 6 months, the bank, it's just a straight up no. If there's 2 or more in the last 2 years, it's a pretty hard ask to go through. So you definitely, even before doing an application with some of those providers, you want to make sure that your credit file's okay, you didn't have any mishaps. It could even be the case where I had one about a year or two ago where they'd closed out a credit card, they'd said to the bank, see you later, rip it up. The bank didn't action that, charged a $10 a month fee, then it kind of compounded over a 3-month period, and it showed that they were 90 days late on their repayments. And it showed up on the credit file, it's on there pretty much permanently. So we had to go back, debate it with the provider. It was a whole muck around, but like Nathan said, try and avoid it in the first case where you can, and keep it all clean. The next point, Nathan, we've got there are, people always say credit cards matter, but I'd argue credit limits matter. So why do credit limits matter? And potentially looking at, how much you owe, as how much the limits are as opposed to how much you owe on your credit cards.
Now, the simplest thing to think about here is with your credit limits, every $1,000 in credit limit you have actually reduces the ability to borrow by about $7,000. So if you've got a $10,000 credit card, that's reducing your borrowing power by $70,000. Now, even if you pay off your credit card every month, the bank will still include this as a liability, because they say theoretically, Jaden, you can max out this $10,000 credit card, then you're going to have a minimum ongoing commitment to pay off that credit card, which is usually 3% of the balance each month. So that's why it reduces your borrowing limit. And it's quite simply one of the easiest ways to increase your borrowing power by just reducing your credit card limit.
Yeah, and the good thing with credit card limits too is in a lot of cases with a lot of banks, you don't actually have to go out and rip it up today. If you're getting a pre-approval, you can make it a condition of the pre-approval. So you can say, Nathan, you've got a $10,000 credit card limit. Don't go out and change anything today. It's okay. You only have to do that if you go for, say, the maximum amount we're going in the pre-approval. If you end up finding a place that's a little bit cheaper, we might not need to do that, or you can leave it. The other thing that makes an impact is like HEX and other payments. Again, HEX is another one where it doesn't matter how much you owe. It's based on your income. So we've got a whole other video on HEX that we'll send that you can check out below. But these are all the things that you want to check out with your mortgage broker to see if they make an impact. If they are, then you can kind of manage it and control it and fix it up today, so it's not going to be a problem tomorrow. The next tip, Nathan, tip number 7, there's been a lot of changes, I guess, post-COVID with the job market opening up, is people are changing jobs. It's inevitable. You might get a job, get a pay rise, that sort of thing. So why is it, I guess, problematic if you change jobs midway through an application or just before doing a home loan application?
Yeah, this is a big one to keep in mind, especially if you're pre-approved, because if you do change jobs, that can change the application quite drastically. Now, it's a lot easier if you're going to a full-time or a part-time role, because some of the lenders will look at if you've got industry experience for the last 2 years, if you've got a new full-time role, but it's similar with no probation. They'll look at a bunch of stuff like that. But if you are changing jobs, speak with your mortgage broker, especially if you're changing to a casual position. The banks at the moment want to see anywhere from 3 to 6 months history in any given casual position. If it's full-time or part-time, yes, some lenders can be a little bit more lenient. So they'll look at one pay slip being a requirement before they'll give you the actual loan application approval. So it's something to be aware of and to be cognitively aware. If you are looking to buy a property soon, talk to your mortgage broker before you make any changes. Make sure it's not going to impact your ability to borrow.
Yeah, generally the way the banks will look at it are, some banks, if it's a permanent full-time role, all you need is a pay slip. With other banks, if you have less than a 20% deposit, they may want 3 or 6 months in that job to consider the income, or if there's not been a 30-day gap between your jobs. There's a couple of different ways they can interpret it. I think chat to your broker, because like Nathan said, you can have a pre-approval today based on the job that you'd had for 2 years. Then you might have a month off, start a new job, find a home, and the bank says, no, we're not going to accept that because it doesn't meet our policy. So chat to your broker. Changing jobs, it should be okay, depending on the job. If it's contract industry, there's a couple other things in there. Next tip number 8, Nathan, try to avoid doing too many applications at once. This applies for credit cards, personal loans, home loans. It's the same thing because it shows up in your credit file, but why else does it affect you, Nathan, if you're doing too many applications at once? What are the banks, how do they see that? Now,
this is one that gets some people because, especially if you're putting down a minimal deposit, the lenders mortgage insurance can see this and go, well, have you actually been declined by that lender, and what happened there? And they may ask more questions and get a bit more suspect. So something to be careful of. One, it does reduce your credit score by doing a lot of applications. And two, it can actually flag the other banks that are assessing your application, looking at these inquiries and going, well, did you actually have troubles with another lender that we don't know about or we're missing? And it might mean that they actually say no to the application as well. So one thing to be very careful of, work with your mortgage broker here. They'll be able to navigate through that. Make sure that you pick the right lender first time so you don't have to keep redoing applications time and time again.
And then, so the next tip, Nathan, is sort of what are the factors that really impact your loan application when they're considering it? So a bit of a summary. So firstly, income, like why does the income affect it? Employment history, savings, deposit. Do you want to give us a quick overview on, I guess, in an ideal world, what looks good from an employment history, savings, deposit perspective, and what probably doesn't present as well when you're doing these things?
I think the main things to be aware of here is the banks are looking for more consistency across the board. So if you've been in your role for 2-3 years and you're on a steady income, as well as that, you're not too high on your debt to income ratio. We gave that example before, where if you're on 100 grand, debt to income ratio 6 times makes your loan 600,000. So if you're going for a 500,000 loan, the banks are comfortable there. You're at debt to income ratio 5 times. If you've been in your role for 2 years, it demonstrates you quite stable in your employment and income, as well as that having a good savings history. Now, you definitely don't need a 20% deposit here, but if you've demonstrated propensity to save, you're paying your rent, you're putting money away each week or month or fortnight towards building that deposit, the bank gets huge amount of comfort there that you've been able to show your ability to pay a $400 rent, plus you're saving $150 a week, so they can see you've got an ability and a propensity to repay up to $550 per week. And the mortgage repayment's only going to be, $390, $400. So that gives them a huge amount of comfort in knowing that you're in a good, strong position and able to repay the debt and get in a loan without any hitches or problems.
Yeah. And then, so the next point, number 10, is why do banks decline loans? What are some of the reasons? I think following on from your point, Nathan, like with all these factors, the income, the employment history, the savings, the deposit, the banks actually, and your credit file, the banks actually do a scorecard in the background. So it's almost like being back at school. They're going to rate you out of 10, basically, of all these factors. There's lots more factors than that. But they're going to say, like, Nathan is a 9 out of 10. You know what? He didn't score amazingly on, say, the genuine savings, but he's had really strong income and his employment history has been really good. So I guess a couple of common reasons that the banks decline the applications are like insufficient income. So like Nathan said, if the lender decides that you've got your debt to income's too high, you've got too many other liabilities, that's a pretty common one at the moment. The second one is probably not having a satisfactory employment history. So for some banks, they, like Nathan said, you might have just started a role in a brand new industry and they might not love that. So just be careful. Other banks are completely fine with that. The third one might be your deposit, not having the genuine savings. So, way to mitigate that's the rental ledger, like Nathan said. And the fourth one's probably concerns over some of the spending habits, if they're in some of those categories that they don't like. So again, it's a good chat to have with your mortgage broker up front to make sure everything kind of ticks those boxes. So there's nothing to worry about. And lastly, the most common reason that we see for loans getting declined this year are probably that postcode thing, right, Nathan?
That's exactly right. So I think postcode's a big one. This is where you can work with your mortgage broker. Even if you have a pre-approval and you purchase a property, the broker can look at the postcode and say, actually, the bank we're with won't accept that and pivot. I had a client recently purchase an inner city apartment. There was actually service apartments in the building, and that was a big no-no for a lot of lenders. So whilst the banks would say, yes, we'll take the inner city apartments at 95%, when we looked into it a bit more, did our research on the property, we noticed the service apartments in there, and a lot of the banks actually said no. Luckily, we were able to find a bank that had no problems with it, but that's just an example of something that could be missed. Like, the brokers looked at the contract, yeah, all good, the bank says 95%, but then they didn't realize the service apartment. So all these things are very important when doing your application to make sure you're working with someone that has experience and understands the process and what the banks are looking for. Here at Hunter Galloway, we get home loans approved. We work with home buyers across Australia. So if you need assistance, hit us up at huntergalloway.com.au. Jade and I are both mortgage coaches here and would love to help and have a chat to see how we can get you approved faster. And please leave a comment below. Tell us a time that you've applied for a loan and maybe it didn't go the way that you thought it would. We'd love to know what happened. And we'd love to have a chat. So thanks guys for watching, and we'll see you again soon.
See ya.